I greet you, ladies and gentlemen, this morning on Friday, the 17th of September, 2021. As I am just about to present to you on money, banking, and the price level. In our previous lecture, we examined exchange rate systems, and we concluded our brief overview with the managed or dirty floats exchange rate system. In this lecture, we are looking at money, banking, and the price level. We'll start with the concept of money. The simple definition of money is that it's any generally acceptable medium of exchange of goods and services in an economy. Money is what is declared by legislative fiat or authority to be such. In virtually all economies on earth, notes and coins are used as forms of money, as well as electronic means of money like mobile banking or cards like the one that I'm carrying, or cards like this MasterCard that I'm carrying. Some they use the Visa card and so on. There's also cryptocurrency. There's so many forms of money in the modern world. But we have got three operational definitions of money, which are broad money aggregates. We've got the M1, which is also called narrow money, which comprises notes and coins, plus demand deposits with the banking sector, which implies the Reserve Bank of Zimbabwe, commercial banks, merchant banks, and discount houses. So this is the narrow definition of money. How about M2? M2 is simply this M1 plus savings deposits plus 30-day fixed deposits with commercial banks. And then M3, it is simply this M2 which contains M1 plus commercial bank deposits of over 30 days and merchant bank fixed deposits plus savings deposits with the People's Own Savings Bank, POSB, built-in societies, finance houses plus shared deposits such as those with building societies, e.g. Class C shares. And the M3 is the broad definition of money. So the M1 and the M2 are narrow definitions of money, with the M1 being the narrowest definition of money and the M3 being the broadest definition of money that you can think of. And then characteristics of money. Commodity money or banknotes and coins are perfectly liquid compared to things like treasury bills or cryptocurrency, which have to be converted. And with commodity money, you can purchase goods and services straight away. Liquidity refers to nearness to purchasing power or the ease with which an asset can be converted so that an economic agent may purchase goods and services in the economy. Other forms of liquid money, which are becoming more prominent in our times, is electronic forms of money. Like I talked about e-money or e-banking. There are 8 characteristics of good money, which are: number 1, acceptability; number 2, scarcity; number 3, portability; number 4, durability; number 5, homogeneity; number 6, divisibility; number 7, stability; and number 8, recognizability. So good money has to have all of these characteristics. If one of these characteristics is missing, it becomes a problem for money to be used for transaction purposes. So it's very imperative that all good money, ladies and gentlemen, contains these 8 attributes of good money. The 8 attributes of good money are very critical for money to be considered money. We move on to the functions of money. There are 3 basic functions of money, and the 4th one, which is surrogate. The first function of money is the medium of exchange function of money, which is the primary function of money, that money facilitates financial transactions in a modern economy. Money eliminates the need to conduct barter trade, which is the exchange of goods for goods without the mediation of money. With barter trade, there has to be double coincidence of wants. If I have a goat and you have got a cabbage, I have to need a cabbage when you need my goat. But then the challenge will be that my goat may be far much bigger than your cabbage. So we'll have a problem. How many cabbages must I get from you for me to release my goat? So this becomes a very serious issue. So the medium of exchange function of money is associated with the M1 or narrow definition of money. And then next to move on to the store of value. Good money must maintain a constant purchasing power for a long period of time. And this function is undermined by inflation. Glass can't be used as money because it's easily broken and loses its shape or integrity. So it can't be used to store money, which is why in most economies, they prefer metals and paper to store value. And then money is also used as a unit of account. Without money, we don't know the correct estimation of the worth of commodities in modern economies. So money serves as a common denominator of goods and services in an economy. And it facilitates the whole accounting profession. And the money is the one which is the inspiration behind people working in different jobs. People will be knowing when they receive money, they're able to purchase different goods and services that are not produced in their company. And then the 4th function of money, which is a surrogate function of money, is that money is a standard of deferred payments, deferred or future payments. The existence of money facilitates the entire credit economic system, upon which rests much of economic activity. This is based on the ability of money to work or function as a unit of account. We move on to the money creation process. In the economics literature in monetary economics, there is a question which we need to answer. Are commercial banks able to create or make money in an economy, in a modern economy? To answer the question that I've just posed about, we have to expound on the money creation theory or the money multiplier as follows. Number 1, we look at the assumptions of this theory. The first assumption is that we assume the existence of a single bank, commercial bank called CPD bank. We assume a reserves requirement ratio of 10%. We assume that no cash leaks out of the system. We assume that the initial balance sheet appears in T format as follows. Our assets are $200,000. We have got an asset of cash, $200,000. And then our liabilities is capital, which has been injected by this bank owner of $200,000. So our assets and liabilities are equal at $200,000. The owner of the bank, Mr. Mtombe, contributes $200,000. That's the narration as capital to the formation of the bank, which implies that we've got an asset of cash of $200,000 and a liability of cash of $200,000. But we have a reserves requirement ratio of 10%, which implies that 20,000 must be retained by this bank, the CPD bank, as a reserves, which implies that the bank is able to lend the remainder, which is $180,000 which for simplification purposes, you may say it's lent to Mr. Mkujin, who opens an account with the same bank because no cash leaks out of the system. And the whole amount may be used to purchase a machine, which costs $180,000 from Belmont machine manufacturers. We have an account with the same bank so that no cash moves out of the system. So this implies that Mr. Mkujini's account is debited with $180,000, which is then credited to the account of Belmont machine manufacturers. So CPT Bank is able to lend 80% of $180,000, which is $162,000, and then add the remainder to the original $20,000, which was kept as reserves because of the reserves requirement ratio of 10%. So with the lending rounds, the new balance sheet B of this CPT Bank will look as follows. After 3 rounds, when we add the figures, we'll be having $487,800 as assets, and then $487,800 as liabilities. The liabilities will be deposits. The assets will be the money which is injected from a previous round, according to the reserves requirement ratio. We subtract the reserves requirement ratio. If we calculate 90% of 180,000, we get 162,000. 90% of 162,000, we get 145,800, and so on. And the rounds, they continue ad infinitum, eventually converging. It's a convergent geometric series. So the initial deposit of $200,000 has created $487,800 total assets at the end of the 3rd round, courtesy of the fractional reserves requirement system. In general, the total money or credit created in this simple commercial banking system is expressed by the following formula for summing an infinite convergent geometric series, which is capital letter S, the sum of the entire series, is equal to capital letter A all divided by 1 minus R in brackets, where S is the sum of the infinite convergent geometric series. A is the first term, like the initial deposit of $200,000, and R is the common ratio, like the common ratio is 90%, because that's the common ratio between these numbers. 180 is 90% of the original to 200,000, and 162 is simply 90% of 180,000, and so on. So the common ratio is simply 90%. It's 1 minus triple R. That's the common ratio. So customizing the formula that was presented on the preceding slide, or slide number 20, we have M, which is the total money created, which is equal to the initial deposit, all divided by 1 minus R. But what is R? R is simply 1 minus triple R. So the formula for the total money created is simply the total deposit divided by the triple R, which is the reserves requirement ratio. So if we say 200,000 divided by 10%, we get 2 million. So the total money created is actually $2 million US. And then the limitations of this mechanism is that, number one, if no money is deposited with the banks, then banks will be unable to create money. Banks are usually risk averse and may not lend all the money that they have at their disposal over and above the required reserves. 3, customers themselves may be risk averse and may not be willing to apply for loans from banks, meaning to say cash will be just left lying idle within the banking system. And then we look at the demand for money. There are three approaches for starting money demand, which are number one, the classical approach, number two, the Keynesian approach, and number three, the monetarist approach. With the classical approach, this approach is attributable to the 20th century economist Irving Fisher, who published his work in 1912, who crystallized the equation of exchange from the writings of British philosopher David Hume and other economic philosophers. The equation of exchange, which is used in the classical literature, is MV is equal to PT, where M stands for the total money stock in the economy, and V is the transactions velocity of circulation, measured as the number of times that an average dollar or rand or euro circulates in the economy in the conduct of commercial transactions. And P is the general price level. T is the total level of transactions in the economy. The assumptions are that V is assumed to be constant, since it is determined by technology and the institutional factors such as the length of the payment period, the pattern of expenditure, access to credit, and expectations about future inflation. And T is also assumed to be constant, since transactions that can be conducted by a given period of time are fixed. The assumptions imply that the equation of exchange can be rewritten as MV over V, which is equal to PT or multiplied by 1 over V. It's like we're dividing through by V. So we'll be having in the next stage M, which is equal to 1 over V, multiplied by PT, the original PT. This 1 over V, we can say it is equal to Ka, a constant, because it's a reciprocal of a constant. The reciprocal of a constant is simply another constant. So finally, our M is equal to KPT. According to the above information, money demand, we now have a money demand function. It is a function of the change in the general price level. Since T and V are constant, K, which is the reciprocal of V, in essence, it's 1 over V. K and T are constant, so money demand is a function of the change in the general price level. The criticisms of the equation of exchange, it is based on very rigid and unrealistic assumptions, in that money is seen as neutral and only affecting prices. We know in the short to medium term, it may not be neutral. In the 1930s, V was observed to be variable, implying that money is not neutral, but affects real economic variables, such as employment, real GDP, and investment, to mention a few. So we look at the successor model, though there is the modern version of the equation of exchange, but because of the problems associated with the equation of exchange, Keynes came up with this liquidity preference theory. Keynes was a British economist who dominated the economic circles in the 1930s and the 1940s before he passed away. So his money demand function is based on 3 motives, which are number 1, the transactions motive, the precautionary motive, and the speculative motive. The transactions demand for money is associated with M1, the narrow definition of money, and places emphasis on money as a medium of exchange. It retains the basic assumption of the quantity theories or the classical theories. It avers or asserts that money is demanded to smoothen the non-synchronous receipt of money and expenditure. People receive money usually once in a month or twice in a month, but they have to spend on a daily basis on transport and other things which they need, goods and services in the economy. The size of transactions balances depends mainly on the level of income and the time interval between receipts and disbursements of income, which is what I was just explaining. Since this is based on patterns of expenditure that tend to be constant over time, TD is assumed to be fixed or constant over time. So the transactions demand is assumed to be just a vertical line at a certain level. And then we have the precautionary demand for money, which is associated with the money needed for contingencies and unforeseen occurrences, which may be bargain purchases or calamities like accidents or sicknesses that normally occur when people have not planned for such things. This is also assumed to be constant, since the occurrence of situations like sickness, bargain purchase opportunities in the future tend to be constant over time. After all, when it comes to things like sicknesses, people have got medical aid. For funerals, people have got funeral policies. So the variations over and above what is needed, they tend to be just negligible or statistically insignificant, such that we can say PT, the precautionary demand for money, is more or less constant as well. And then we move on to that aspect of the demand for money according to J.M. Keynes, which is affected by the interest rate, the speculative demand for money. This is predicated on the use of money as a store of value or wealth, or money taken as an asset. Economic agents willingly hold money balances over and above their transactions and precautionary demand for money because of their desire to hold money as an asset that is perfectly liquid and relatively free of risks, though inflation undermines the holding of actual money as an asset. The speculative demand for money is primarily determined by interest rates as follows. Money holdings, that is money balances, are a substitute of holding wealth in terms of other financial assets, near money financial assets such as treasury bonds or treasury bills. The future value of a bond, which is the substitute for money according to the narrow definition of money, notes and coins, is FV, the future value, which is equal to the present value plus the present value multiplied by the interest rate, the interest on the present value, where PV is the present value or price of a bond and R is the interest rate. So if R is the interest rate, PVR is the interest on the present value. So we add the interest on the present value to the present value to get the future value. So from that, we can calculate now the present value in terms of the future value. If we factorize PV here in this first statement, we'll have PV factor of 1 plus R, because PV is common there. PV into PV is 1. PV into PVR, it is simply R. And then we'll be having PV factor of 1 plus R. Now, we can divide by 1 plus R on both sides, and we'll have PV being equal to FV, future value, divided by 1 plus R. As you can realize, there is an inverse relationship between PV and 1 plus R, because on the right-hand side, R appears as the denominator, implying a negative relationship between the two. If we hold FV constant and you increase R, it will be reducing the resultant PV, ceteris paribus. So the formulation above simply tells us that PV, or the price of a bond, is inversely related to the interest rate, meaning that if the interest rate is increasing, the price of a bond will be decreasing, which is its present value. So if we reckon a bond or a treasury bill as a normal good in the money market, a rise in the interest rates implies a decline in their price, thereby increasing their quantity demanded. All other things being constant, we have to hold constant what is happening in the other parts of the financial or financial markets, like stock markets, for instance. If the quantity demanded of the bonds increases, this implies a running down of money balances. So when the interest rate is increasing, we expect money balances to be going down, because economic agents will be buying the cheaper bonds or treasury bills. But if the interest rate is declining, the price is increasing of bonds, implying that less and less bonds are being kept in the portfolio of these economic agents or investors in the economy, implying an increase in money balance, ceteris paribus. So the total money demand, according to the three motives, we have TD, which is constant, PP, which is constant, and speculative demand, which is inversely related to the interest rate. After doing this horizontal summation, we get MD, which is inversely related to the interest rate because of the speculative demand for money, which is inversely related to changes in the interest rate. So basically, the foregoing analysis implies that total money demand or overall money demand has an inverse relationship with the interest rate, which is shown by the bold demand curve, which when we change other things in the economy, like expectations and the host of other monetary and non-monetary factors, it may shift the money demand outwards, like when national income increases in the economy, people will demand more money for transactions purposes at each and every interest rate. At each and every interest rate, they'll be needing more money for transactions purposes after a change in national income, maybe due to fiscal policy or due to an investment multiplier and all of that stuff. So the money demand function can shift outwards or inwards, depending on factors that are prevailing in the money markets or in the wider economy. So the equilibrium in the money markets occurs when there is an intersection between money supply, which is held to be just a vertical line, this vertical line, and money demand, which is held to be this downward sloping line. And money demand is downward sloping because of the speculative demand, as we saw, for money. So where the two lines cross each other, we've got equilibrium in the money market. So we've got an equilibrium interest rate, which is marked as R star, and money, the total money availed in the market is M star, which coincides with the money stock availed by the government through the central bank. So if you look at an exchange rate of R0, for instance, it leads to excess liquidity in the money markets because money demanders at that high interest rate, they will demand MD0 amount of money. Yet money which will be available will be M star. The discrepancy between MD0 and M star will be the excess money supply or excess liquidity in the money markets. In contrast, if the interest rate is R1, we have got excess demand for money or tight liquidity, like the situation which we're having in Zimbabwe in the past, before the new dispensation or before the government that is operating at the present moment. So at R1, money demand is now outweighing or outstripping money supply at M star. The discrepancy between MD1 and M star represents excess money demand or tight liquidity in the economy. So money supply is perceived as fixed since it's an institutional variable determined through the central bank. We can't argue that money supply is determined by interest rates because the government through the central bank can set those interest rates through the bank rate and through other monetary policy instruments. So if the government has got many ways of injecting money supply through the buying of treasury bills and through many other mechanisms. So we look at monetary policy. We start by looking at goals of monetary policy before we look at monetary policy instruments. The first goal is full employment or increase in employment or reduction in unemployment. The second goal is high levels of economic growth, which is normally associated with the surrogate goal of high levels of investment. And then price stability or low levels of inflation. The balance of payments balance with monetary policy can also be used to ensure a balance of payments balance or an equilibrium. Monetary policy can also be used for exchange rate stability. If there is too much money supply, it may undermine a country's currency. And then the monetary policy instruments, they include open market operations, the reserves requirements ratio, which I used in explaining the money creation multiplier, the prescribed asset ratios, which are also called liquid asset ratios, moral suasion, and direct quantitative controls on lending. We look at open market operations. These make use of treasury bills, TPs, to control money supply. To increase money supply, the central bank simply buys treasury bills or shorten their tenure. I'll correct that spelling, or duration or lifespan. To reduce money supply, the central bank would auction treasury bills at attractive rates, thereby mopping excess liquidity. So money supply may be increased or decreased to affect aggregate spending or aggregate demand in the macroeconomy. And then with the reserves requirement ratio, which we used in explaining the money creation mechanism or the credit creation mechanism, this is the ratio of reserves to deposits, as we saw earlier on. There are reserves against demand deposits and against time deposits. The ratio is determined by statute through the central bank. An increase in the reserves requirement ratio reduces the capacity of the banks to lend to their customers. In Zimbabwe, for quite a long time, the RRR has been around 20%, but you can check for the latest figures. And then we have got prescribed asset ratios. This refers to requirements of liquid asset reserves over and above the RRR. These are imposed by the central bank in order to control liquidity in the money markets. This policy instrument is also used to control inflation, which is driven by excess money supply linked to money market trading activities. And then we've got moral suasion. The central bank governor meets senior managers of banks or bank executives to discuss pertinent issues affecting the monetary sector or money markets. The resolutions that are made in those meetings, though they may not be legally binding, they are generally adhered to by banks for the good operation of the monetary sector or the entire banking system. We have got direct quantitative controls on lending. In the past, especially in the 1980s and also in the 2000s, between 2003 and 2008, during Dr. Gideon Gono's quasi-fiscal activities period, the government, through the central bank, directed lending to certain sectors of the economy which were considered strategic, such as the mining, agricultural, and tourism sectors of the economy. This was meant to boost employment and enhance capacity utilization, thereby driving economic growth in the Zimbabwean macroeconomy. And then we look at price indices and the general price level. A price index is a normalized average, typically a weighted average, of prices for a given class of goods or services in a given region during a given interval of time. It is a statistic designed to help to compare how these prices taken as a whole differ between periods or geographical locations. Price indices have several potential uses. For particularly broad indices, the index can be said to measure the general price level, the economy's price level, cost of living. So we've got three formulae that are used in the literature and also empirical to calculate the consumer price index. We've got the last year price index, which is simply the summation of the current prices multiplied by base year quantities. and divided by the summation of best year prices multiplied by best year quantities, all multiplied by 100/1. This differs from the PASH price index, which is a summation of current prices multiplied by current quantities, all divided by the summation of best year prices multiplied by current quantities multiplied by 100/1. And then we've got the Fisher ideal price index, which is a geometric compromise of the last pair and the PASH, in the sense that it finds the square root of the product of the last pair price index and the PASH price index. So you can use the data which is presented in the table below of the prices of different commodities, bread, sugar, and tea, and their respective quantities to calculate the three respective indices. You can calculate the last pair, the PASH, and the Fisher ideal index. You can use that on your own to calculate. So for the time being, I believe we have covered enough on banking and the introduction to inflation. So in our next lecture, we'll be looking at different types of inflation. So you can just use this example. I will send the slides so that you can follow this example and you use it. You can copy it as I allow it to be there before I send the slides. For those who are following online, I'm allowing you to copy the figures and you can play the video and then copy the figures and calculate these indices by, first of all, coming up with a table of summation of Pn Q0, P0 Q0, Pn Qn, P0 Qn, and then you sum those and then you feed into this formula. You get your indices. So we'll meet in our next lecture on inflation. Thank you so much for joining in this lecture. I hope you benefited from this exposition that I've just given. Have a